Welcome to the Boston Exit Plan Consortium biweekly meeting and podcast. My name is Kevin Dougherty. I lead KD Partners Advisory, a sell-side merger and acquisition brokerage firm focused on businesses in the $3 to $50 million revenue range. Our topic today is the state of mergers and acquisitions in the current market, looking at 2023 year-to-date and expected market conditions in 2024. With us today to discuss the state of the M&A market is Greg Rush. Greg is co-founder of Dunn Rush & Company, a sell-side brokerage focused on deals in 20 to 25 million revenue range. Greg is responsible for business development, transaction execution, and firm operations. Greg has deep experience with various types of transactions across a host of industries, including consumer, industrial, manufacturing, media, retail, business services, technology, and defense. Prior to Dunn Rush, he served as managing director for Citi Capital Strategies, Citigroup's middle market investment banking platform, where he established the Boston office in 2007. Previous to that, Greg spent more than 8 years in investment banking with Tucker Anthony Incorporated and SunTrust Robinson Humphrey, where he was responsible for the origination and execution of corporate finance assignments for both publicly traded and privately held companies. Greg also was chief operating officer of a community newspaper company called C&C, which was a cluster of 100 newspapers with specialty publications in the Boston region that was owned by Herald Media. Greg received a BA in economics from Dartmouth College and is a registered investment banking and securities representative, compliance officer, and operation professional, and appropriately licensed in all those areas. So Greg, thank you for spending this time with us today. Let's dig into the discussion.
Thank you, Kevin. Good to be here.
Greg, as we look back on 2023, inflation, although beginning to abate in a meaningful way, is still very high. Further, the Fed action of raising interest rates has increased the cost of money. As a result, raising money to fund deals and, importantly, operating a business profitably, pre and post-close, has become challenging. As I speak with many clients, I see themes emerging in the local market. That is, these inflationary and cost of capital pressures are challenging operational and financial performance of smaller companies and compressing valuations. Also, in many cases, suitability and preparedness for taking these companies to market. And most importantly, through the rigors of the M&A process, specifically the diligence process and quality of earnings. So Greg, what are the trends that you're seeing in the M&A market as we finish this year? Where are valuations headed? Have deal terms been impacted? What's the market telling you?
Yeah, well, thank you, Kevin. It's sort of a long question. I do have a couple of slides that I'm gonna move through here. As we've talked about, by the way, all this information is available afterwards. But the current 2023 has been a pretty interesting year in M&A. We're coming off of what have, by all accounts, been the most active years in 2021 and the first half of 2022 in terms of the number of transactions that are happening that the M&A market has ever seen. So, I think we saw the highest Q4 of all time, followed by the highest Q1, 2, 3, and again Q4 of all time when you went from 2020 through the end of 21. And it really has been a bull market since we came out of the 2008 financial crisis. 2010 right on up through, we use the term bouncing along the ceiling in terms of number of deals that have happened. But what we've seen in 23, and it started with some of the trouble in the commercial banking market, which underpins the financing for a lot of transactions and really ties to how companies get valued. I think the year came out of the chute slow. So when we look at the beginning of this year, the first quarter was off about 24% versus the first quarter of 22. We saw a similar number, off 27% in Q3. We think it's going to be off about, Q2. And we think it's going to be off about 20 to 30% in Q3. Those numbers, in an absolute sense, seem like a very down sort of environment in M&A. But what I would say along all that is you're coming off of those record quarters. And when you look at the volumes we've seen for 2023, even given some of those statistics, we're back to where the volumes were kind of in 2019. And so there's still a lot of transactions happening, and there are tons of dollars out there looking to be put to work in the middle market M&A environment. So, we definitely are watching some of the trends that inflation and higher interest rates have on the number of deals and the valuations of deals, and certainly the cost to borrow that underpin those deals. But I think 2023 has been not as strong as the last couple of years. I think it's been a haves and have-nots market. So companies that are doing really well have continued to be able to get their deals done, and sort of the companies whose financial performance may have slipped a little bit due to economic conditions, have been forced to kind of sit on the sidelines and wait while we get some, sort of hopefully some stability in the market.
Well, that leads me to my next question, Greg. What about higher interest rates and increase in inflation? I mean, what's the impact on the market? Borrowing costs. I mean, what does that mean to a person trying to buy a business and a person selling a business as well?
Yeah, I think there's a couple things there, and I think maybe I can touch on a slide that we put together here, and maybe so stepping back. I mean, we track data a couple of different ways. We look at the overall transaction statistics that are happening under $250 million in enterprise value, and we can track the health of the market based on how many deals are happening. It's hard to get the underlying data on what the valuations of every private company would be, because they don't have to report that. Even the valuations of some of these deals don't have to be reported. But we use a database called GF Data, which is a really unique resource for people like us. Since the early 2000s, this group has been collecting data from 300 to 400 private equity firms and family offices and other types of holding companies that are constantly doing M&A transactions. And they submit their information to the database on an anonymous basis, so that folks like us can slice that by industry code and really get a good handle on data that would otherwise be unavailable. So valuation statistics, you can look at caps and collars and seller financing. It's really kind of an interesting thing. We can also take a look at some of the trends in pricing. You ask about interest rates and inflation. I think it's definitely seen the cost of borrowing go up and impact how deals are getting financed. And when you look at this bottom chart here, well, the top chart kind of looks at, in the deals that are reported on this database, which doesn't speak for the whole market, but it is a subset of the ones they collect. That's a pretty sizable chunk. You're seeing total debt kind of in and around that 4 times level. Senior debt of that, represents 3.25 to 3.5 historically, and that's kind of come down a little bit as you look out to these last quarters here, as you get to Q2 and Q3 of 2023. But you're still about 3 times senior debt and about 3.75 times total debt at the end in the third quarter this year. The other thing that's interesting on the bottom is you look at the pricing. And, I think there's an asterisk on the green line being where, sub debt and mezzanine debt prices their cash coupon, which is only part of the pricing for sub debt, because sub debt's also, as you know, Kevin, going to include things like warrants for an equity kicker. They might have payment in kind interest that's going to increase the return that someone that's subordinated to the senior debt would require to finance something. But the coupon is what they typically pay in cash. And it's kind of always hovered around that, 11, 12%. That goes back many years. But what's interesting here is you see the interest rate that senior lenders are charging on the financing for senior debt has also increased and started to squeeze that gap and get up over 10% for the first time in a long, long while as we've gotten to Q3 2023. So, I think that does a couple things, right? It increases the cost to borrow. It increases the burden on an acquired company for the cash flow that they have to generate to be able to pay the debt and the interest costs on that debt. But I think the more impactful thing on valuations that inflation does is it really impacts the financial performance of the underlying companies, and that rely on, whether it's consumer or industrial or business customer bases. The health of those businesses and the health of the cash flow and the margins and the growth profile really has, I think, been squeezed in 2023 for a lot of companies in a lot of industries. And I think that has a bigger impact on the M&A market. The other factor, of course, if the banks are lending a smaller multiple of EBITDA, that's going to directly impact pricing on M&A transactions as well. Rule of thumb, historically, half of a valuation is usually provided by debt and half from equity. That mix has squeezed a little bit upward so that the equity contribution is now a hair over 50% when you look at these statistics. But I think it's more about, what are the lending multiples that banks, that's where interest rates can really crunch down valuation. And, I think the health of the underlying business is really what's going to direct how things go in 2024.
So, Greg, what do you see in 2024, and what should an owner be thinking about if they're going out?
Yeah, I think it's a great question, right? I think we've gotten together with different industry groups and people comparing notes. I think people are looking at interest rates in terms of where they are now, and thinking that we've reached a level of at least predictability or stability that we haven't seen for the last year or 18 months. I think the concern over economic downturns and where inflation was going, things ramped up pretty rapidly, and I think that's a hard environment for business owners. It's a hard environment for lenders and M&A professionals looking to acquire companies, because it's all about predictability. And when there's higher risk, I think that causes people to pull back on how they think about valuing businesses. So much of what we talk about when you think about preparation of things, it's just knocking down the risks. If you can reduce the risks, valuation is about risk and cash flow, and that's it, right? So like if you can knock down the risks and increase your cash flow and the assumed cash flow of a buyer, that's where you're going to get the strongest multiples and the strongest valuations for your business. We hope that, I think having some stability, we don't necessarily see interest rates coming down again. I mean, we benefited from really low rates for a really long period of time. But I think if they can stabilize and just not be accelerating upward, which it feels like that's started to happen, I think that's a little more predictable. It's a little easier for business owners to manage. And I think the businesses can get to kind of a new normal. And I think a lot of the financing sources and the private equity firms that are driving a significant portion of the M&A market that's out there can use that information to kind of continue to do high levels of transaction volumes for healthy, profitable businesses.
Excellent. Thank you so much. I guess take the uncertainty out of the market, and we'll have a more normal market.
Yeah, I think the other question you asked, Kevin, is what can people do, while you're in this sort of time frame, while you're getting ready. A lot of companies weren't prepared because their numbers weren't great, or they didn't have that visibility into the 6-9 months ahead that you really need to kind of run through and drive through this process. And I think, there's the thing that I think this group will understand, it'll resonate well, is prepare is the answer. Right? I mean, there's never been a good transaction that gets completed where someone stops at the end and says, boy, I wish I'd done less preparation. It just doesn't happen. Right? So in fact, I think the opposite is true. People are so busy running their business, they're getting barraged by people all the time, that they just don't take the time to speak with and learn from the professionals that have been through this dozens and dozens of times. But, we use something we like to coin the Dunn Rush gold standard of preparation, where if it's not the perfect timing for your business, do something about it. Figure out how you can get yourself in position to be able to do whatever you want to do on your own terms, whenever you want to do it. And, I think it's important to kind of be as prepared as possible, not just for the things you want to do, but to be able to handle the things that are unexpected that come across. And the interesting thing about this list of things, this is just a good business practice. So even if you don't ever want to sell your company, or you want your grandchildren to run it someday, being, sort of buttoned up and having all these things done doesn't just reduce the risk for buyers or financing sources. If you want to go out and do a deal, it reduces your risk if you have all these things and you understand all these things. So, I would say, to come clean on this list, there's never been a company that has all of these things, right? I mean, this is like a true, it's expensive, it's time consuming, it takes a lot of resources to do these things. But if you've ticked these things off, you've done just about everything you can to get yourself ready to go. And I think we've got some resources that we use. This list is one of them. We've also done a presentation that I know we've talked about, Kevin, where we have people focus on creating value when they look into the market, and if it's not the right time, trying to be ready to get there. And we have a presentation called Would You Buy Your Business, which is stepping back and take a critical eye of a third party and analyze, how you perform on a matrix. Gartner uses the term magic quadrant for these things, but how do you perform relative to others on a series of quantitative and qualitative factors? And how can you improve your size, your margins, your growth rates, your team, your competitive dynamics? There's a whole host of things that we use, and we've got some tools on our website that we can go through with companies as well. But I think preparing and trying to get ready when now's not the right time, make sure you are ready when it is going to be the right time for you.
Thank you, Greg. That's excellent. This material will be available on our website, bostonexitplanning.org. And Greg's information is also on there, but you can reach Greg at grush@dunnrush.com. And on behalf of the leadership of the Boston Exit Planning Consortium, Greg, thank you for your time and sharp insights into the current M&A market.
Thank you, Kevin. Appreciate you guys having me.